If you've ever thought, we need capital, whether that means funding growth, stabilizing cash flow, or setting up an exit, you probably also felt how messy that conversation can get. Today, we're simplifying with a framework I love, a four-legged foundation for capital success. The legs are relationships, data, analytics, and process systems. And here's the big idea. If one leg is weak, the whole thing wobbles.
I like that already, because people talk about capital like it's just about pitch decks and valuation. But in real life, capital decisions feel more like trust decisions. Like, do I believe this team can execute, and can they prove it?
Exactly. And that's why the four legs idea works. It's not only about raising money. It's also about getting the right kind of money at the right time with the least regret later. So let's walk the four legs and connect them to three common goals: raising capital for growth, working capital for sustainability, and preparing for a full or partial exit.
Let's start with relationships, because I think that's the one people underestimate the most until they're in a crunch.
Relationships are the first leg for a reason. Capital is rarely won on a single meeting. It's built across a network: investors, lenders, advisors, customers, suppliers, and even your internal leadership team. And it's not just about knowing people. It's about credibility over time.
So if someone's listening and thinking, okay, but I don't have those relationships, what do they do? Because it can feel like an exclusive club.
You build it like any other long-term asset, consistently and before you need it. One practical shift is this: stop reaching out only when you're fundraising. Instead, keep a steady rhythm of updates. Short, clear notes. What you shipped, what you learned, what metrics moved, what your next milestone is.
That's such a good point. Updates let people track your trajectory, not just your story. And I've noticed that when companies do that well, the actual raise looks less like persuasion and more like alignment.
Yes, and relationships don't only mean investors. If you're solving working capital problems, your relationship with your bank, your vendors, and your customers can be the difference between breathing room and panic.
Right. If a customer trusts you, they might sign a longer contract, pay faster, or agree to different terms. If a vendor trusts you, they might extend terms. Those aren't small details, that's cash flow.
And if you're aiming for an exit, relationships show up as reputation. Buyers ask around. They talk to former employees, customers, partners. Your track record travels faster than your slide deck.
Okay, second leg, data. This is where I see founders get tripped up, because they think data means a million dashboards. But usually the problem is the opposite: missing basics.
Exactly. Data isn't about volume. It's about having the right facts in a consistent form that you can stand behind. If you're raising capital, investors will ask, how fast are you growing? What does retention look like? How efficient is your customer acquisition? What's your margin profile?
And if you're pursuing working capital, they'll ask, what's your cash conversion cycle? How quickly do you collect? How long do you take to pay? What's inventory doing? So the data shifts a bit depending on the goal, but the expectation is the same. You know your business.
Yes, and I want to say this plainly: messy data signals risk. It may not mean the company is bad. It may just mean the company has grown faster than it's reporting. But to the people providing capital, risk is risk.
Also, if you're preparing for an exit, data becomes proof. Buyers and diligence teams want clear financials, clean customer data, understandable cohorts, and a story that matches the numbers.
Totally. The confidence in your data sets the ceiling on how confident someone can be in your forecast. And your forecast often drives how they price you.
Which brings us to the third leg, analytics. Data is what happened. Analytics is what it means. It's the difference between revenue is up and revenue is up because renewal rates improved in this segment, and we reduced churn through these actions.
That's a great way to put it. Analytics turns numbers into decisions. It answers questions like, what are the leading indicators? Where are we leaking margin? What's the lifetime value of a customer by segment? Which products drive expansion? What happens if pricing changes? What happens if demand softens?
And for working capital, analytics is where you find the hidden levers. Like, if we change our billing terms from net 60 to net 30 for new contracts, what does that do to cash? Or, if we adjust reorder points for inventory, how much cash do we free up without hurting service?
Yes, it's not just we need more cash. It's here are 3 options to improve cash. Here's a trade-off for each. And here's what we're choosing. That is a capital-ready conversation.
And for an exit, analytics helps you defend value. Buyers will try to find reasons to discount you. Strong analytics lets you explain anomalies, show resilience, and demonstrate repeatability.
Exactly. You're not just handing someone a pile of reports. You're showing them a machine they can understand and trust.
Which brings us to the 4th leg, process systems. This one is the least glamorous and maybe the most important.
Process systems are how your business runs without heroics. It's how you close your books reliably. It's how you approve spend. It's how you forecast. It's how you onboard customers. It's how you manage renewals. It's the repeatable way work gets done.
And capital providers love repeatability. Investors want scalable operations. Lenders want predictability. Buyers want a platform that won't fall apart when the founders step back.
Exactly. If relationships get you in the door, data helps you answer questions, analytics helps you make the case, process systems prove you can execute consistently.
Let's make it real. Suppose I'm a business owner listening right now. I want growth capital. How do these 4 legs show up in a practical plan?
Great framing. For growth capital, relationships means you're not starting cold. You've been nurturing contacts, advisors, maybe a short list of target investors who understand your category. Data means you can show clean metrics like growth rates, customer retention, unit economics, pipeline, and margins. Analytics means you can explain what drives growth and what you'll do with the money with scenarios. Process systems means you can show the business won't break when you scale headcount, volume, or product lines.
Now, different scenario. I'm not trying to explode growth, I'm trying to get stable. Working capital. What changes?
You still need all 4 legs, but the spotlight shifts. Relationships might focus on your bank, lenders, and key commercial partners. Data focuses on receivables, payables, inventory, burn rate, and cash runway. Analytics focuses on what levers improve cash without killing demand, like payment terms, pricing, collections, procurement, and staffing models. Process systems focuses on financial discipline, a tight monthly close, clear approval workflows, and a forecast you update regularly, not once a year.
And the exit path, full or partial. That is where a lot of people realize they've been building a company, but not necessarily building a company that can be bought easily.
Exactly. Exit readiness is basically the 4 legs under a microscope. Relationships. You've got a reputation in the market, and ideally a healthy relationship with potential acquirers or deal intermediaries. Data. Your financials are consistent, defensible, and easy to diligence. Analytics. You can explain growth, churn, margins, concentration risk, and a roadmap with clarity. Process systems. The business isn't dependent on one person's memory. It has documentation, clear responsibilities, and stable operations.
Let's talk about the wobble. If someone is strong in 2 legs and weak in 2, what usually happens?
You get friction. Say you have great relationships and a compelling story, but your data is messy. Meetings go fine until diligence starts, and then momentum dies. Or you have good data but no analytics, so you can't interpret it and you sound uncertain. Or you have analytics and a sharp narrative but weak process systems, so people worry execution will fall apart.
The worst is when you think the problem is capital, but the real problem is the foundation. You keep asking, why can't we raise? And the answer is, because this isn't investable yet.
Yes, and that's actually empowering, because it means you can work the plan. This foundation is buildable.
So if we had to give listeners a quick self-audit, like a gut check they can do today, what would it be?
Here are 4 quick questions. 1 per leg. Relationships. If you needed capital in 90 days, who would take your call and why? Data. Can you produce accurate core financials and operating metrics quickly without scrambling? Analytics. Can you explain what drives results and what you do under different scenarios? Process systems. If a key person disappeared for a month, would the business still run smoothly?
Those questions hurt a little, but they're useful. And they help you see what to fix first.
And fixing doesn't always mean buying expensive tools. Sometimes it's just choosing a cadence, monthly reporting that's consistent, a simple forecasting model, a short list of KPIs, a clear approval process for spending, an investor update template, basic documentation for core workflows.
And a mindset shift. Treat capital readiness like operational fitness. You don't wait until you're injured to start training.
That's the line. Because whether you're chasing growth, stabilizing working capital, or planning an exit, the four-legged foundation is what keeps you steady. Relationships open doors. Data earns trust. Analytics creates clarity. Process systems prove you can deliver.
And when those four are strong, capital stops feeling like a desperate scramble and starts feeling like a strategic option.
Exactly. Build the foundation first. And the funding conversation gets a lot less stressful and a lot more successful.